Next is my favorite topic. We're going to talk about non-QM loans or non-qualified mortgages. Now, what non-QM means is essentially that the loan doesn't fit in the standard box for a conforming loan that would be purchased by Fannie Mae, Freddie Mac, FHA, VA, USDA, any of the other programs that we just talked about. Non-QM loans are kind of like the wild, wild west of mortgages. Different rules, different risks, but sometimes the perfect fit for buyers who just don't check the usual boxes. So I'm sure we've all been in a position where we've had a self-employed customer shows us their tax returns and it made them look like they were broke. But then you look at their bank statements and it told a whole different story. So non-QM programs are probably going to be the best bet for that customer. So these are customers that just don't fit traditional lending. And some of the examples of the programs that we have for non-QM programs are a bank statement program. This program is great when you've got a customer that's self-employed and they have to have at least 2 years worth of history of owning that business. The customer has to provide proof that they've had the business for at least 2 years, and we can do that via business licenses, LLC documentation, business bank statements, things of that nature that would allow us to determine that the customer's been in business for at least 2 years. We get either 12 or 24 months, there's different program options, 12 or 24 months of their bank statements. We take the total of all of those deposits into those bank statements, cut it in half by 50%, and that's the income that we use to qualify the customer. So if you've got that self-employed borrower, and for the last 2 years, they've basically taken advantage of the tax loopholes that they're allowed to take advantage of, and they've written off business expenses. It appears as though they're just not making as much money as we know they probably are, then the bank statement program's an awesome option. Another example of a non-QM program is going to be our DSCR program. DSCR stands for Debt Service Coverage Ratio. This is a term that we typically hear about in commercial lending and less on the residential or primary residence side. And what these programs do is they allow real estate investors to purchase investment properties using the income that's generated by the asset to support the debt. So no personal tax returns, no personal income statements. There are bank statements required because we do have to document the source of any funds that are being used to purchase the property, but we're using the income that's generated from the rent on the property to offset the debt, and that is what we use to qualify them. The income from the property has to be at least 1.2 times the total amount of the mortgage monthly payment. So if the payment on the mortgage is $1,000 a month, then the income generated from the property after vacancy factors would have to be at least $1,200. Next, we have asset depletion loans. And for asset depletion loans, we typically see these products used for customers that have low income but a high net worth. So let's say, for example, you have a customer and they're retired and they haven't started collecting the income that they could be receiving from IRAs or 401ks. Maybe they just have a small Social Security benefit that they're currently collecting. And they have a significant amount of funds in their retirement account. We take the total amount that's in their retirement account and we divide that up over the life of the loan that they're getting, and we can use that in the form of income without actually depleting the account. So this is great for your, again, for your borrowers that, you know, they're collecting their Social Security, but they haven't had to touch their 401k yet just because they don't need it for living expenses, but we can use it to help them qualify for a mortgage. And then lastly, we have what we call our fix and flip program. I'm really excited about this program and I haven't had an opportunity to use it yet, but this is again a program for real estate investors. This is a new option for us. And this allows real estate investors that are interested in purchasing properties, fixing them up, and then reselling them within a short period of time, it allows us to finance the acquisition costs as well as the construction to fix the property up. So if you're an investor and you're looking to buy and sell quickly and use as little of your own funds as possible, this is a great option. This program is a 6-month program, so they have to purchase and sell the property and fix it up within that 6-month time frame, but just a great program for investors. Now, all of these programs do come with higher interest rates and down payment requirements. And the reason being is that they're riskier programs for the investor, so in order to offset the risk, we typically see higher interest rates, but all great options for customers that don't fit in the normal box.